We've just published the May edition of FX Talking, and we say that FX markets are feeling the squeeze. And they're feeling the squeeze because of three key factors. The first of those factors is rising US real interest rates. 10-year real interest rates have pushed into positive territory. This is driven by the Fed wanting to take some steam out of the US economy, wanting to slay the inflation dragon, and this is sucking money into the dollar and sending it to the highest level since 2002. The second factor, of course, is war in Ukraine. The stagflationary shock and obviously the human tragedy, this is impacting clearly European growth prospects. And the third factor that we've seen over the last month has really been the reassessment of Chinese growth prospects. Chinese growth forecasts revised lower, but importantly for FX markets, it's seen the dollar renminbi become unanchored. For almost over a year, we've seen dollar renminbi trade in a 635 to 650 trading range. But recently this has surged to 670, and investors are worried or are taking the view that perhaps China wants a weaker currency to stimulate the economy as well. So where next for FX markets? Well, unless you think that the Fed is going to blink and not tighten policy further, and that's not the ING view, we think Fed rates will be taken up to 325 in Q1 next year. And unless you think there's some benign outcome for the war in Ukraine, or you think that there's going to be some massive fiscal stimulus in China, I think you'd probably argue that we'd see a continuation of the recent trends. At the moment, the FX options market's price is a chance of euro-dollar hitting parity by year end at about just over 30%. We would probably say the chances are higher than that.